All right, hello everyone. If you've ever truly wanted to know how to actually go about investing in real estate, and more importantly, how to buy your very first rental property, then you're in the right place. This is not about purchasing a home. It's about purchasing an asset that can literally transform your financial future. We're going to make the entire process easy, beginning with the thinking strategically that you'll need and concluding with managing your property like a pro. So let's begin. So why rental houses? Well, it's not merely a matter of receiving a rent check each month. A quality rental property provides what I call the quadruple benefit. For starters, you receive cash flow. This is the actual income you receive after all the expenses have been settled. It is the profit that shows up in your bank account each month. Second, you get appreciation. Someday, eventually, the land the house is on and the house itself will gain value, quietly growing your money for you. Third, there is principal paydown, and this is a sly, intelligent one. Your rent payment from your tenant is quietly paying off your mortgage loan for you. So every month that passes, you own a greater and greater amount of the property. And fourth, and this is a doozy, you have tax sheltering. The government is thanking you big time with incredible tax savings for being an investor in real estate. You can deduct maintenance, property taxes, and mortgage interest. But the MVP here is depreciation. It's not a cash expense, so you get to write off the theoretical wear and tear on the property as income from taxes, which can provide your rental earnings significant tax haven. It's a cost saver. Now let's talk about a level up strategy that can be an absolute game changer, especially if you have a high W-2 income. It's called becoming a real estate professional, or REP, with the IRS. This is not for all, but if you can qualify, the benefits are huge. You have to spend more than half of your working hours in real estate activity, and you have to work more than 750 hours a year on your rental properties. Time spent on acquiring, managing, rehabbing, everything counts. So what's the big deal? Well, without this status, any losses your property incurs are passive, and you can't deduct them against your regular salary. But with REP status, those losses become active. This is a big deal because it means the paper losses you incur from depreciation can be used to lower the tax bill on your high W-2 income. It basically turns your rental property into a tax-saving machine. Okay, so now let's get down to the nitty-gritty of how exactly you qualify for a loan. Lenders are going to check you out a heck of a lot more for a rental property than they would for your personal residence. They look at three things. 1, your credit score. For a conventional investment loan, you typically have a minimum of between 680 to 700. But in order to qualify for the best interest rates, which saves you heaps of dollars over the life of the loan, you'd want to have a score of above 740. Second, they look at your debt-to-income ratio, or DTI. That is all of your monthly debt payments divided by your gross monthly income. For an investment property, they prefer it to be under 45%. But to get the best terms, you actually want it under 28%. And third, you need cash reserves. The bank wants to know you can handle vacancies or a big repair, so they'll often require you to have liquid assets, cash in the bank, equal to at least 6 months of mortgage payments just sitting in reserve. So they'll often require you to have liquid assets, cash in the bank, equal to at least 6 months of mortgage payments just sitting in reserve. And how in the world are you actually going to pay for this anyway? Let's add up the main funding routes. You've got your standard, conventional investment loan. This is where you won't be occupying the property. The surprise? You'll require a hefty deposit, 15% for a standard residence and a staggering 25% for a multi-dwelling property. And then, of course, you have the heavy-hitting house hacking tactics. With an FHA loan, you pay only 3.5% down, but you must occupy one of the units. You can have a credit score of only 580. If you're a veteran, a VA loan is the holy grail, 0% down, and you simply must occupy one unit. As you can tell, house hacking lowers the barrier to entry greatly, which is why it's the go-to method for the majority of first-time investors. Let's just take a moment and really appreciate the strength of house hacking. This is, without doubt, the optimal way to begin real estate with virtually no money. The The concept is simple. You buy a duplex, triplex, or fourplex. You live in one, and you lease the remainder. Because you're owner-occupying, you become eligible for those amazing low down payment loans we talked about earlier. 3.5% with an FHA loan, or even 0% with a VA loan. All of a sudden, you're not just paying for your own mortgage. Your other tenants are subsidizing it for you, typically paying most or even all of it. You're effectively living rent-free or at a steep discount and building equity and getting all those quadruple advantages. It's a great entry tactic. Now, an important aspect of being a good landlord is knowing your costs, and one of the largest categories is capital expenditures, or the CapEx. So what is CapEx? It's not regular maintenance. CapEx is an important repair or replacement that keeps the property in place longer. Think about replacing the roof entirely, putting in a new heating and air system, or replacing all the pipes. These are big, occasional, but very reliable costs. Maintenance is fixing something that's broken, like a broken faucet. The key difference is in accounting. Maintenance is an outright deductible expense, whereas CapEx is something you amortize over a number of years. Therefore, you need to budget for these big-ticket items. A good rule of thumb is to budget 10 to 15% of your gross rent every month, or budget approximately $100 to $300 per unit, depending on the age and condition of your property. Otherwise, one large repair will wipe out your whole year's profit. Before you ever even go check out a particular property, you need to select the right market. You need to invest in an area that is feasible and has room for expansion. Where do you find this information? Start with free government sources. The U.S. Census Bureau gives you demographics and housing figures. The Bureau of Labor Statistics gives you employment and income data. And your city government website is nugget gold for zoning ordinances, property tax rates, and planned infrastructure projects. If you require greater detail, there are commercial platforms like CoStar and LoopNet, which can offer detailed information on commercial listings and trends in the market. PropStream and Reonomy are platforms that can offer you advanced analysis of property valuations and records. Conduct your research here. A good location is non-negotiable. Once you've got a market, how do you go about analyzing a specific property? You use a step-by-step hierarchy of analysis. Start with the 1% rule. This is a rough and quick screening tool. Does the monthly gross rent come close to at least 1% of the whole purchase price? If not, it's probably not a good cash flow opportunity. Strike it from your list. Then, you can look at the gross rent yield, which is just annual rent to price. It's a bit more specific. More sophisticated is the cap rate, or capitalization rate. This is return on the property, independent of financing. You take the net operating income and divide it by the value of the property. It's useful for apples-to-apples comparison of various properties. But the most important number for you, leveraged investor, is your cash flow analysis. This is the final boss of calculations. It's your gross income minus all operating expenses minus your mortgage payment. This will tell you the real money you'll be putting in your pocket each month. Let's make those important formulas real clear because you have to live by those. First, NOI, or net operating income. This is your property's annual profit before you pay your mortgage. The formula is simple. Total annual income minus all your operating expenses. Then, the cap rate. You take that NOI number and divide it by the value of the property. This will give you the unleveraged return, and most crucially, your annual cash flow. That's your total income, less operating expenses, less your annual mortgage payments. This is also called debt service. This final number is the one that will let you know if you can afford to pay your bills or not. A chunk of property could have an amazing cap rate, but if the mortgage payment is too huge, you'll have negative cash flow, and that's hell. All right, you found a working property. Now the good stuff begins. Due diligence. This is not the fun part, but it's the part where successful investors get created and people lose their shirts. Due diligence is the diligent exercise of verifying everything regarding the property, its physical state, its legitimacy, and its financial history. You are essentially performing a background check to see if there are any skeletons in the closet. This is your ultimate shield against buying a money pit or overpaying based on inflated numbers. On the legal side, you've got a checklist. First, a title review. You have to confirm who legally owns the property and whether there are any nasty surprises, such as old liens or claims against it. Number 2, zoning compliance. You must ensure that leasing the property is even allowed, and search for any covenants, conditions, and restrictions, or CC&Rs, that might limit what you can do. Number 3, an ALTA survey. It's a detailed map that pins down the exact property lines and shows any easements, like a utility company's right to access some of your property, or encroachments where a neighbor's fence just so happens to be on your property. And number 4, certificates of occupancy. Those prove that the building actually complies with code and is safe for humans to occupy. And finally, the financial confirmation. You can't trust the seller, naturally. You have to have sight of the papers. You will want to perform a rent roll analysis, which is a listing of all the leases that exist, who the tenants are, and whether anyone is in arrears. You will need to verify the T12 statements, which are the last 12 to 24 months of income and expenses. That is the real story of what occurs on the property. Get estoppel certificates. These are signed by the tenants and confirm their rent rate, security deposit, and lease date to run. This prevents a tenant from telling you down the line that they had some other arrangement with the former owner. And finally, verify the seller's CapEx budget. Are they playing it real in the high-dollar repairs on the horizon? That's how you don't end up buying on fantasy numbers. Never ever skip the professional home inspection. This is when you hire a professional to go through the property with a fine-tooth comb. They'll check the foundation, the roof, the plumbing, HVAC, electrical, everything. This inspection is your sole biggest bargaining leverage. If the inspector does find a huge issue, like a damaged roof or an outdated furnace, you have some options. You can go back to the seller and negotiate the price down lower. You can ask for a closing credit to repair the fix, or if it is actually bad, you can simply walk away from the purchase. This one step costs you tens of thousands of dollars. Now let's return to taxes, because this is where you can really excel. We just covered depreciation. The IRS lets you depreciate the building cost over 27.5 years. So, you take the worth of the property, you subtract the land worth, and you divide that by 27.5. That's your annual depreciation deduction. But you can give it a turbo boost with a cost segregation study. It's an engineering study that breaks down the property into its components. Instead of depreciating everything over 27.5 years, it identifies components that can be depreciated much more rapidly, over 5, 7, or 15 years. Such items as appliances, landscaping, and some fixtures. This front-loads your deductions and gives you tremendous tax savings in the first few years that you own the property. And remember, to fully benefit from these accelerated losses against your W-2 income, you need that real estate professional status we discussed. It all interplays. One of the most common questions asked is, should I title my property in an LLC? An LLC, or limited liability company, creates a wall of law between you and your rental property. Its main purpose is to shield your personal assets, like your own savings and your family home, if someone sues you on the rental property. It's not completely good news. An LLC makes it more complicated. There's an annual state fee. You need to have a separate business bank account, and franchise taxes are possible. The sooner you act, the better, before you close on the property, so the LLC can take title directly. If you already have it outright, then transfer it. But you will have to very carefully keep your lender from triggering their due on sale clause. An LLC is a great defense, but it's not armor. You have to still have great insurance. Speaking of insurance, you can't just use a standard homeowner's insurance policy on a rental property. It's not designed for that risk. You'll need landlord insurance. The two key distinctions are liability coverage and income protection. Landlord insurance insures liability only for landlord-tenant situations, i.e., if a tenant is injured due to a maintenance issue you didn't deal with. And most significantly, it has loss of rent coverage. If there's a fire and your property is uninhabitable, this policy will cover you for the lost rental income while it's being fixed. Homeowners insurance won't. This is an undisputable to protect your business. Your renters are the lifeblood of your business, so finding the right ones is maybe the most important thing you do. The days of a quick glance at a credit score and an immediate yes or no decision are in their final throes, and in some jurisdictions, illegal. You need to use a holistic assessment. Look at the whole picture, their current income and stability of employment, solid references from previous landlords, and overall circumstances. Most cities have now restricted the use of past criminal or eviction histories, so it's prudent practice to use shorter look-back periods. The key to staying out of trouble is to employ clear, written screening standards, which you use exactly the same manner to each and every one of your applicants. Consistency is your defense. And lastly, who's going to handle this property? You've got two choices. You can employ a professional management firm. They'll take care of it all, but it'll cost you usually 8 to 12% of your gross rent. Or you can self-manage. That saves you that fee, and that right there boosts your cash flow. But the real big reason to consider self-managing your first property is those 750 hours of real estate professional status. Time spent managing the property, dealing with tenants, arranging repairs, earns you those hours. And if you hire in a manager, your own time investment plummets dramatically, and it becomes well-nigh impossible to qualify for that lucrative REP tax status. For the majority of beginners, self-management is the path to increased cash flow and better tax status. So, bringing it all together, here are your 5 success tips. Number 1, prioritize house hacking. Enter the game with low money down through an FHA or VA loan, but expect to refinance in the future to get rid of that permanent mortgage insurance. Number 2, prioritize cash flow analysis. The 1% rule is a good starting point, but the only number that matters is your cash flow after the mortgage. Number 3, invest in due diligence. Review the seller's figures and don't ever skip the inspection or the legality review. And don't forget to purchase that landlord insurance. Number 4, negotiate your tax strategy on day 1. Ponder if you're going to request real estate professional status. If you have a high income to shelter, it's a winner, especially when paired with cost segregation. And number 5, stay legal. Engage in fair and reasonable tenant screening, and don't shy away from shelling out a few dollars for an attorney's speed session. It's far less expensive than a lawsuit. Do this, and you'll be well on your way to successfully buying your first rental property and building real, long-term wealth. Thanks for watching. Good luck! If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.